Wall Street says you can't have high returns without high risk. They're dead wrong. Today, we're breaking down how accredited investors can achieve 10% plus passive returns without Wall Street fees or the volatility. We'll talk about real assets, Midwest cash flow, and how to filter out bad deals so they don't drain your yield. All right, so in this video, I've got 5 things I wanted to talk to you about. The very first one is how to achieve this is by focusing on real assets, not paper promises. It's through real estate, as through real estate debt funds or private lending. At the end of the day, when done correctly, all 3 of those, real estate, debt funds, or private lending, can equal predictable income. Tangible collateral at the end of the day over paper assets reduces the risk because it's oftentimes very slightly correlated to the stock market. And they actually are underlying assets, meaning that they're real assets, real property, and they have utilization. They have value associated with them and their usage through typically rents at the end of the day. Avoid the hype. Avoid the hype-driven investments. When people are writing a lot about these things, Wall Street is a machine that just is a giant producer and purveyor of itself. You don't hear about certain other things. Why? Because Wall Street can't capitalize on it. It's not part of their machine. They deem real estate an alternative asset, which, for most of us, it's our single largest single asset that we own. I'm not sure what's alternative about that, given that 65% plus or minus of us as Americans own our own property, own our primary house. Number 2, cut out the middleman. Cut out those layers and reduce those fees. Whenever you're looking at investing in something, you should be asking, how does the other side, certainly if you're getting advice or if you're entering into an agreement with somebody, how do you get paid? How much do you get paid? And at the end of the day, how do you get paid? You're the single individual, right? You're the investor. Avoid the fund of fund structures. Oftentimes they're layered with fees. A fund of fund is simply you're going to come into a fund. There is a fee level at the fund, and then they're going to invest in other funds, incurring other fee levels. So oftentimes those fees get stacked up there. Simplicity keeps more of the yield in your pocket at the end of the day. Number 3, Midwest markets. Midwest markets equal better cash flow. Those coastal markets, the Californias, certainly the Phoenix of the world, and that East Coast, certainly New York and lots of Florida. Uh, at the end of the day, they achieve returns by appreciation only. By appreciation only. No underlying cash flow. The benefit of underlying cash flow is that when debt gets underwritten by a bank, they are looking to get paid back in one way and one way only, cash flow. The bankers want to know, how do I get paid back? Through cash flow. In the appreciation world, it's a whole nother story when how they underwrite and how much money has to go into those things. So the coastal cities, they're flashy. There's no doubt about it. They're just low yield. Midwest, steady tenants, high cap rates in comparison, and stable appreciation at the end of the day. Kind of the best of both worlds. The cake and eat it too. Cash flow and appreciation. Number 4, debt beats equity due to its predictability. Secured first position loans protected by capital. Think of it much like a bank. Banks are relatively low risk and relatively stable returns at the end of the day. Just cash flow machines from a bank standpoint. What we do at the hard money side and lending through a fund is the same thing. We're typically achieve yields at an investor level, no doubt, at double digits, and at our fund level, even higher, because we're lending out to people who need to borrow money, and we go inside a first position, and they're stable cash flowing machines. Number 5, cash flow over growth. Consistent distributions oftentimes can out return speculative exits. The risk associated with consistent distributions is not particularly high. When we go into a first mortgage position on a property, pretty low risk. People are putting money down. They're buying it below market values oftentimes, and they're going in and repositioning a property. Versus the other side of speculation is taking wild swings, and you never know what's going to happen exactly. Compounding income builds real freedom at the end of the day. Single or double digit returns, they'll compound over a period of time versus wild swings where you could end up with a loss that sets you back. So, double digit returns, they don't require real estate. You just need to find the right private deals, the right partners, and focus on cash flow first. You wouldn't believe the amount of real estate investors I know who are worth 10 plus $1 million who have little to no cash flow, and you just can't eat equity. So, if you want to see exactly how we structure deals or interested in learning more, I dropped a link below in the description and you can learn about that in detail.